Have a good afternoon. Good morning. Hey, morning. Good to see you. Ryan, good morning. Hey, Ruby. Tyson, I'm very well, thank you, Tyson. Doing very well indeed. Suk, good morning. Rajiv, hey, guys. Good to be with you all. Morning, Joe. In fact, while it's in my mind, Joe, I was thinking about something for you in particular. Um, it is obviously be helpful for all of us, but it's a little trick, right? Um, little macro lesson here. As you all know, right, bond markets influence interest rate expectations strongly, right? So when you have, like, take the US bond, for instance, right? You can see that, as the US bond yield goes up, do you see how the interest rates go up, right? That's the same for countries all over the world, right? When you have yields going up of a bond, the currency follows suit. So if we were to overlay the Dixie, right, onto this, right? You see that as the yield goes up, the currency goes up. You see the way that they're very closely correlated. Okay. And you look at the moment, you can see there's a gap, isn't there? The yields are going up and the currency wants to go up, right? Now, one of the tricky things, Ryan, you still here? Yeah, okay. I think I just unmuted someone. I was just checking I wasn't like kicking them out by accident. So Ryan, I hope you're still here. Oh, hello. Yeah. Yeah, that's great. Okay, I was just checking out and booted someone out the webinar by accident. Um, so this is how you can use the bond market. This is what we use when we're doing the yield spreads. Okay, so here you can see at the moment yields are going up, and what we're expecting for the Fed, we're expecting interest rates to go up and the dollar to go up, right? Now, sometimes um, that relationship breaks down, and we've seen that in UK gilt markets recently. When you see the yield going up, but the currency going down, because there is a time when bond yields go up, but it's not because markets are expecting interest rates to rise, it's a sign of distress. Because remember, this is the yield that investors will get for lending to the government. So if you think about it, when markets are really distressed, you'll see the yield go up, but the currency go down, and that's a sign of distress. So what this will help you with is, say at some point in the future, and Joe, this will help you with your understanding, okay? Say at some point in the future, there's another UK election, and it's controversial over which party is going to get in, and there's genuine fear, and you start to see a bond yield go up at the same time as the currency goes down. That's a sign of distress. And it can result in very fast selling when that happens. We've seen it happen in the US Treasury market when Trump was putting tariffs of 145% on China. We saw it in the UK when Liz Truss was going to have unfunded spending in an inflationary environment. We saw distress in the bond market. We've seen it in the Eurozone when there was issues over Greek debt, Italian debt, and we saw distress in all those bond markets when the yield of the bond went up, but the currency went down. No, it'll help you, right? And it was what twigged it for me. I was doing an interview for Times Radio, and it was an interview that was based on the reflection of a bond trader, and it was a female bond trader, and she had a very good way of shortcutting this, and it was very simple, and I took it from her. She was just saying, no, she was watching the yield go up, and then she was just thinking, well, if the pound starts selling off, that's when it's really real trouble. Very, very simple, and in one sense, I know we know that, but very practical. She was there on the desk. Do you know what I mean? All the busy hubbub around, watching the yield go up, and she's got one eye on the pound. And so that's exactly what we should be doing, exactly the same thing. When the yield is going up, if you suddenly see the currency going down sharply, it's that sign of distress. So just keep that in your mind. Otherwise, the yield goes up, the currency goes up, the yield goes down, the currency goes down. That's the relationship, except in times of distress. When the yield goes up, because the Investors want more interest to borrow to a risky government, and the currency goes down. All right, just a little one, and that's one for you, Joe. I hope is that relatively clear for everybody? Yeah. Yes. That'll help you, Joe, right? What it'll do will help you really understand when the markets are really panicked versus like normal corrections. Yeah, it is valuable, right? And that'll be helpful. Okay, good. Now, today, where are we? Let's just go over to let's look at the reds. We've got the US-Iran talks going on. Obviously, it's a constant cacophony and a mess of events, claim, counterclaim, strike, counter-strike. The deal's on and off. It's kind of the okey cokey deal. It's on, it's off, it's on, it's off. Now, we know why that is. The US want to say the deal's going to be done as soon as possible. Iran wants to drag it out for as long as possible. Both of them are using rhetoric, political guile, and miscommunication to yeah, Ruby, yeah, that's 30 exactly. Incredible, right? And we know why he wants to do that. Because, and we know this, and I remember seeing this at the time, this is linked to the bond market. Um, President Trump will, he's not, a foolish man when it comes to finances. He'll be looking at that bond market. And so he knows he's got to keep that bond market contained. All politicians ultimately serve the bond market. Ask Liz Truss, right? If the bond market starts showing sign of panic, your whole economy collapses. You can't borrow money. If you can't borrow money, you can't fund current spending. So all politicians ultimately serve that bond market, and that's what Trump needs to keep saying. The deal's there. It's nearly there. We've got it. It's round the corner. Oh, It's the best, etc., etc. And so far, the market's buying it. And I think what the market's really buying is they know that Trump's not going to hit the self-destruct button, right? He is respecting the bond market. And as it currently stands, the expectation is there'll be a bumpy, quasi-weird kind of deal that eventually kind of works. And to look at how markets are really looking, just keep looking at the oil market. I think that gives you the best indication of what markets are really thinking, right? And oil staying under that 196 in line with yesterday's data for the CPI. Um, Now remember what we said, if you remember, I said look at that month on month core inflation rate. If that comes in at 0.2%, right, for the core, that will be taken as like a good sign. And notice the headline, as expected, 4.2%, the core as expected, but it's that core reading that markets have taken some comfort by. Remember, we said that. So that means the dollar strength is still there, but the analysts I'm reading are saying, okay, we can maybe get through this little bump from the high oil prices, and second round effects are less likely to come into action. And you can see that current expectations, yes, they're still highlighted from a high from a week ago, but they haven't just bumped up on yesterday's CPI. Now, today, the important print is the PPI print. Now, PPI, it's the Producers Price Index. And what this will do for the US is it will give us an indication of how much inflation prices are rising for producers. As sure as eggs is eggs, if producers' price inflation goes up, then CPI for the consumer goes up. If producers are paying more, then consumers will eventually. Now, producers can't just automatically pass on prices to consumers because consumers might not buy your product. But eventually, it does filter through. So this will be important, and this filters into the Fed's preferred measure of inflation, the personal consumption expenditure, PCE print. It's been the Fed's preferred measure of inflation since 2012. So two reactions to look out for. The headline reaction, if it comes in above maximum, so if it's 6.7% or higher, 1% or higher for the month-on-month core, if it comes in at 1% or higher, then what you're looking for there is immediate upside in the dollar, right? No, 30, yeah. Yeah, and counting, aren't we, guys? Yeah, Ruby, 38. We'll probably have two more, on this webinar. Um, yeah, funny. So hot inflation is dollar strength. Fed's meeting next week. We're in the blackout period. What are we? We're in a buy the rumor, sell the fact situation. So you see, buy the rumor, right? Dollar weakness, dip bought, dip bought, hammer reversal, hammer reversal. So this is dollars going up, right? So first trade idea today. Who do we have meeting yesterday? Bank of Canada. And if you look at the Bank of Canada, we were expecting a dovish response. And if we just go to the daily European opening news, you'll see where's CAD. Let's see with the central bank. All right, we'll just go and have a look at the Canadian response yesterday. CAD were weaker. The expected bank decision to hold rates had little bearing on price action. The release and accompanying remarks from Macron were rinse and repeat from April, with current policy appropriate for a patient approach in a soft labour market, combined with a clouded inflation look, which poses risk of becoming persistent. Bank of Canada money market pricing was little change in the aftermath, right? There was ING came out reading it as more dovish than the News Squawk headline is giving it credit to, and ING was sort of saying, okay, they uses they're talking about looking through inflation. Yesterday's policy update, and that CPI print for the US that'll help them. Okay, and what's happening to oil prices? They're sort of pressuring lower. So everything says, okay, dollar CAD upside. So here's my dollar CAD trade. This is fine for today, right? You got hammer reversal, price moving higher. Um, so there's two ways. If you get like a disappointing PPI print, so say it comes in weaker, then looking to buy off that 13957. 5 point stop, try up to three times, right? Right. That's fine. Also, looking on the 15-minute chart, as it currently stands, look for a high tight flag pattern. Right, we're breaking out fresh highs. You're looking for a flag, right? So what you're looking for is at some point today. Remember, we've got the data, but what you're looking for is where is she? Yeah. So do the consolidate. So imagine you get that, right? And then you get sort of something like this.
I think this in Aladath, they report that
Then what
he's
you're looking
really
for,
strikes are targeting
imagine it goes bounce, 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 and then you go with the break. So we're looking for a tight flag pattern. Buying off this 13956 is great. So, in other words, if we see the PPI come in like maybe slightly disappointing, then I'm looking to buy the dollar CAD. So that's my deal for today because broadly speaking, you've got dollar CAD the yield spread, do you see? Yield spread's pushing up. So any retracement back down to that level is suitable. And there'll be whole load of range of other options there. Like it would also be suitable to go do this. If you got a deeper retracement, that would be fine as well here, like that. And you're kind of echoing um, a little bit what we're getting with the euro dollar. We're looking for, there, you've got the breakout of that trend line. You see how that's held. And dollar Swissy, again, any deep dips suitable and kind of hit target 800. That's a reasonable area
just to acknowledge
to
from
take
the
profit.
ECB
Probably going higher, might test it a little bit more. And you can see here that, right, is a pin bar inside pin bar. That is saying lower prices. You see that? So that, you know, I, that's just suitable for shorting, basically, like that. Now we've got the ECB meeting later. So you might get some choppy price action, but this from a price action perspective, wants to go lower. So what you're looking for here is opportunities to go short. Um, the ECB, I think markets are just waiting for the ECB decision now.
To establish a new fund.
Look at the short-term interest rate markets. They're pricing in 2 interest rate hikes. What's the ECB going to say more hawkish than that? They can say it, but it's positioning for more dollar upside. That's the market positioning. The cleanest expression of that for me is dollar CAD upside. But euro dollar shorts remains suitable, right? This looks like it wants to go lower. Okay, folks. So euro dollar downside. Also, I'm happy to buy in euro pound at the 8,600 here. You can also, that is not unreasonable. Entering here at the 0.8633 with like a 5, 6, 7 point stop to the upside. But that's higher risk. At the 8,600 is suitable for buying. So euro pound buying from the 8,600, a 50 point stop on it. Dollar CAD suitable for buying from the where is it? From the 3,956. Euro dollar suitable for shorting. Again, looking for tight flag patterns in the euro dollar on the downside. The difficulty with the euro dollar is you've got significant data coming up. The PPI, so soft PPI. If this surprises and you see the euro dollar rally higher, then I'd look for selling opportunities. The ECB, they're expected to hike interest rates. They're expected to signal one more interest rate hike. Anything above that will be a surprise. Otherwise, the markets are pricing in ECB interest rate hikes this year too. So they were unlikely to give a hawkish surprise. Okay.
Comes in at 1.62 times on a yield of 3.03%, selling 4 billion of the indicative 3.5 to 4 billion range.
My favorite trade of the day is this one, is dollar CAD upside from the 3,956. And or the high tight flag pattern that we're expecting to form. So that would be the one that I put priority number one. Obviously, number two, watch out for dollar yen. The higher this goes, the more likely we are for Bank of Japan intervention. Could get intervention any time. Just having automatic entries at this kind of level, the 1,624, so that you take profit, move to break even like 20 points. But those two short entries are fine as well. But you need automatic entry software to do that. Okay, folks, that is all for now. Do take care, and I look forward to seeing you later. Yeah, take care, everyone. Cheers, Ruby. Cheers, Ryan. See you, Joe. Take care. See you, Morning.